Welcome to Breaking Banks. Welcome to Breaking Banks. I am your host, Brett King. This week, we have the return of our good friends and sponsors and supporters, FIS. We're going to get into their global innovation report. It's got some really interesting stuff. We're going to cover off embedded finance, ESG, and decentralized finance, or DeFi, as it is known, and jump into more of the innovation stuff. But before we do that, one of the things that is at the foundation of these elements is the speed of innovation that's affecting the industry. And as we've seen in the last few weeks with the disruption around Silicon Valley Bank and Credit Suisse, and so forth, I think that a large portion of what we're seeing happening in the space right now is innovation related. The adaptability, the ability to run newer credit risk models based on data science and AI, behavioral models, things like that. And increasingly, we are going to see a struggle as banks try to become more ESG compliant and things like that. This requires some fairly significant innovation in terms of the tech stack as well. So I think it's a good topic for us to dive into today. I'll introduce our two guests that are joining us. We have Melissa Cullen. She's the Global Head of Strategy, Product and Commercialization at FIS Banking Solutions. Melissa, welcome to the show.
Thank you. Very happy to be here.
Absolutely. And also joining us is Tony Warren. He's the Global Head of Strategy and Solutions Management at FIS Capital Markets Solutions. Tony, welcome to Breaking Banks.
Thank you very much, Brent. And again, very happy to be here.
Fantastic. So I think let's dive into this topic of embedded finance, first of all. And maybe as a definition of this, maybe, Melissa, how would you define embedded finance? And particularly, feel free to give it an FIS slant.
Yeah, sure. I think when we talk embedded finance, everyone has a general concept, but the specifics can sometimes be hard to pin down. Really, the way I think about it as we're looking at solutions at FIS is it's simply an extension of the consumer experiences we've grown accustomed to, right, in our personal lives. So you think about the immediacy, the convenience that we expect in basically everything we do. Now it's taking that convenience and really bringing it to all sorts of financial transactions. So whether that's showing up to buy a computer or deciding where I'm going to invest next, it's being able to offer financial services at the point of need. And those are no longer just coming through your traditional financial services providers. So it's opened up the door to a lot of fintechs or neobanks to enter the game as well.
No, I think, if we look at what banks do when we're talking about, traditional delivery of financial services and distribution, it's very much been a pull model where you go and ask the bank for something, and then we see if you qualify, or as I used to call it, the lucky to be a customer scenario, right? If you're not too risky, maybe we'll let you have a banking product, right? So that's the old model, but technology has shifted that. As you've said, it's all about now low friction, low latency, real-time delivery of financial services. And in doing so, the really interesting piece of this is to design financial services products for that real-time environment where you don't have an application form, you don't need a signature, you don't do any of those traditional distribution mechanics. The traditional products you would have distributed through the branch using those old methodologies aren't a clean fit to the sort of technology layer. And so, I think there's organizational structure changes here. I think there's metrics changes, but how do you think banks and financial services firms are responding to customer behavioral change on this side of the equation?
I'm gonna, well, Melissa needs to answer because she runs banking, but I'll also just give my 2 cents here as well, which is it is all about, in my mind, this is all about the advancement of technology. It's the advancement of the availability of data, and now the introduction of more sophisticated artificial intelligence and algorithms that can be at the point of entry. So there's just so much instantaneous, I think, decision trees that can occur behind the scenes, which really do lay the foundations now to really do whatever you want at point of entry. But Melissa, as I said, I don't want to steal your thunder because you really are the banking guru, but I think it does have this big advanced technology play to it as well.
Right. Well, none of this would be able to be brought forth if it wasn't for the fact that we can now offer technology not in the monolithic stacks that it used to be, but really more componentized. And the data point is really what it all comes down to. Banks know that they're not, the whole Brett analysis of, hey, we're going to tell you if you qualify. Embedded finance, and especially some of what I think we're going to see really soon with ChatGPT, is turning that on its head. It's going to be, hey, am I willing to do business with you? And now we're finally offering that out to the market. So.
No, I think that's an important element. If you look at the componentization, that you talk about, and of course that flows on to design these days with cloud-based services, Kubernetes, containerization and stuff. That we're doing that from a technology perspective, but just if you start taking things like identity verification processes and the ability to capture someone's identity in real time, for opening a bank account. I'd argue that a lot of that innovation was driven by fintechs pushing for that. My experience is, working with the likes of HSBC and other global brands at the time of the .com boom, that there wasn't, a lot of pressure from incumbent banks to have that type of technology. But from an FIS perspective, you guys have obviously had to build a lot of these sort of component capabilities to extend on FIS's overall platform capabilities. So it's interesting that I think from a pure banking industry perspective, we think a lot more of technology not just as a core system anymore, but sort of a range of technologies. So from a strategic perspective, you hear fintechs talk about their tech stack, whereas banks still talk about their core systems. How do you think that's sort of coming together? Is embedded finance the mechanism to create a sort of more tech stack view of the world?
My perspective, I think it's just one of the use cases. It's certainly going to help drive it faster. But I've always been a proponent of, hey, in the very near future, we're not going to buy, our clients are not going to come to providers like FIS to buy a system. They're going to come to buy capabilities to enable a specific use case of how they need to interact with their own clients. Luckily, we started the journey before we actually knew where it would end up. So through our Code Connect library, right, that's really where all of our APIs are offered out to the market, whether it's a bank or to a fintech that we might service. There's over 1,000 APIs in there now, billions of transactions each year. And I think that's just going to continue to grow because that is going to be the new buying model that we end up with at the end of this decade.
I think it will shift. I think it will shift more to platform as well, to Melissa's point, rather than kind of individual products. So even for the consumer, at the end of the day, it's all about information being available online, real time, mobile, app based. Um, and right now, you're still going to different suppliers to do different things within the financial services industry. So typically, a bank is still perhaps separate to your investment account and savings accounts, etc. So I think it's going to shift quite quickly now into savings products, retirement products, current account, saving account. Just the whole thing will really come together to allow a completely frictionless environment for the consumer.
Well, so when you talk about platformification of banking, we're really talking about quite a different ecosystem that's emerging for delivery of financial services. We have technology players that are broadly involved in fintech, or in a delivery of banking type services today. Apple comes to mind, of course. If you're in China, it's Alipay and Tencent WeChat Pay as examples. And then, of course, you have specialized fintechs. Fintechs that have created their own brand. You've got players like Stripe and others who are, becoming sort of part of infrastructure, at least for SMEs. But you've also got fintechs that work, consistently with banks now, providing banking as a service platforms. You've got fintechs that service other fintechs. So it seems like the lines are blurring between sort of technology delivery and finance. I mean, even the core bank account today, more people globally use a mobile wallet than they do a debit card for their banking. Yeah. So that in itself is a proof point. How are those lines blurring, Melissa?
I think when you see, like when we asked for in the Global Innovation Report, how embedded finance is really going to change the dynamics, we asked both fintechs and traditional financial services providers. The answer was unanimous, that it certainly came down to new distribution mechanisms. So you talk about Apple, right? And how do I enable my transactions, my financial service procurement through what could be Apple Glass, when the newest versions are released, call it in the next year to two, or whether that's, hey, simply walking into a store today with your mobile device, and being able to transact without the traditional cards, right? So it all comes down to data availability and making that available. Fintechs have done a phenomenal job at mining that data quickly for client acquisition. What banks have, though, is so much more data. So if they can evolve their own analytics to really offer up, right, build on the foundation that they've had, they'll be in a strong position to continue to compete.
But isn't that ability to leverage the data, isn't that also based on sort of like organizational strategies? Because so much of that data is siloed. That's one of the benefits fintechs have is they don't have those traditional silos in terms of the view of the data. They don't even have a traditional org chart in terms of the product teams. You don't have a savings team and a mortgage team and a credit card team in a fintech. You just have the data team and the technology delivery team. So how do we break that sort of organizational sort of process and strategy hurdle, I guess?
I'll start, and then Tony, I'm going to kick it to you. I think the window is really narrow for financial institutions to do this and to get it right. So start breaking down those silos, because we are very rapidly approaching a period of time where it'll go back, right? I think Gartner did a report recently that said, I don't know, before the end of this decade, call it, customers will all have access to and own and control their own data and enable what banks or fintechs can use in order to offer them services. So, right, being able to drive insights and leverage it has to happen quickly. Tony, I know you've done a lot of work on the cap market side of bringing together data for clients.
Yeah, absolutely. And I think what you just said there, I think the industry at large, to be honest, it's not even within like a fintech company versus financial services company. I think it's still spread between different entities across the sort of the value chain, if you will, from a financial services perspective. I think the banks still play more holistically, but now you have specialist areas as well as you get deeper into the capital markets industry, wealth and retirement, etc. But I think the shift will be, to Melissa's point, you will start to get through technology. You're going to get a one-shop stop, and it's everything from payments to be able to just move your money. And payroll is another interesting one, actually, how it will intersect with your own revenue coming in on a personal point of view. And then you've got things like tax, you've got regulations, etc., around the financial controls as you start to get into the investment as well as the payments world. So I think there's a lot of stuff going on. And it is still relatively immature, which I think is the interesting thing. But data is changing so fast now. Access to data, the frictionless movement of data, the digital delivery, the AI algorithms that you can put behind the scenes, that we're going to see a rapid evolution over the next 2 to 3 years, I think.
Well, it also, I think, changes the mix of, the in terms of how we measure excellence in the space. If you look at the likes of WeBank and Nubank, two big challenger banks, they've consistently demonstrated lower NPL ratios, lower credit risk than their equivalents. And one of the arguments traditional banks had for saying why fintechs weren't a threat, at least 10 years ago, was they'll never be able to do credit risk management as good as the banks will. And the reality is that's a technology problem.
That's right.
Yeah.
So this sort of brings in the life of AI here. Obviously everyone's talking about GPT right now. We just saw GPT-4 released last month, and ChatGPT before that. GPT-4, in terms of what the improvement we saw on that from GPT 3.5, which was the ChatGPT tech, significant advances in just the space of 4 or 5 months. You've got Mid-Journey version 5 out now with some incredible generative capabilities in terms of images. Like generating photorealistic images of people, that are indistinguishable from a real photo. It's pretty impressive tech, but we are yet to really see generative AI impact the banking space. In terms of the report, where does it indicate the more medium term or near term implications of generative AI are for the financial services space?
I'll take this one to start.
Yeah.
So when we look at some of the findings from the innovation report, right, it was throughout. However, this is what I think is interesting. It was a very internal look, whether we were talking to, our corporate clients or whether we were talking to our financial clients. How are they going to use it to improve their offerings out to the market? What has completely not been exposed, and I think is very important for the next iteration of this report, will be, what's really going to tip the scales when clients start using it to make those evaluations, to decide, right, where are you investing? How are you
investing? That's right.
So I think that is where we will see a real ramp and a need to respond.
And I think you're right, Melissa. So once you've got a tool where you can ask simple questions, and even that's going to turn into advice. I mean, think about it. It's going to turn into advice.
Right.
Because by the nature of it, it's generating a response to a question or a query based on the whole of the information that's out there in cyberspace. So then coming back with a very logical answer through algorithms, and I think it will really change the way society behaves as well. I mean, I can go on about this a lot because I think there are some pitfalls. I mean, you think about education to youngsters. You know, why go and trawl through books where you can just ask this thing and it will produce your thesis.
So education is going to have to change. It's going to have to adapt.
Education will have to change because
as a mom to an 8 and 10-year-old, I could tell you, I mean, they're already using it, right?
Yeah,
hey, exactly. You don't know the answer, mom or dad? Let me ask Alexa. She'll know it.
Yeah. Exactly.
Well, you know, if you look at the generative AI stuff, it's obviously trawling massive amounts of data. Now, when it comes to something like the financial advisory space, you know, we've got this, but it also applies in the legal field, the accounting field, you know, medical field. We have a situation where these algorithms will be able to consolidate all of this advice. It's been, you know, or the expertise that's been built up over decades and synthesize it down into just the perfect kernel of information. And the reason we go to lawyers and doctors and you know, tax experts is because they know more about this than we do. But what happens when these generative AI algorithms produce better advice than humans?
That's right. This is a slippery slope.
Well, it's a slippery slope, but you know, I mean, what do you think the impact of it is going to be on the advisory space over the next 10 years, Tony?
It will be wholesale disruption of the advisory space. It has to be. So it has to be embraced, and it has to be a tool that the advisory space uses, and it's figuring out the value add, if you will, of the advisor of interpreting the data that you get back. You know, it's the quality, then the delivery to the end customer. But it's going to be an interesting few years, that's for sure.
So it's man plus machine is the advantage rather than man versus.
Well, it has to be right now, right? It has to be.
I think that's a great point in terms of now. I don't think it's going to replace it. The human element of going and making sure you
in the short term.
In the short term.
But I do think, hold on, there's a definite risk there, right?
I think it's going to be used to evaluate who you're doing business with and whether your advisor is you have the strongest advisor giving you the advice, right? That's how I think that there'll be a lot more checks and balances that, quite frankly, people don't have today. They don't know. They don't spend the time doing the research, and now this is a shortcut to the research.
So that's the point, isn't it? How do you choose an advisor today? You choose someone who gives you the best advice. If you don't have AI in the equation, then you can't keep up. Be the best advisor.
You're not going to be able to keep up. Is the bottom line. So it has to be a combination. I think another important area is the if you think about, I'm going to just shift, Melissa, if you don't mind, over to my neck of the woods in capital markets. So if you think about how that ecosystem works between the buy side and the sell side, there is a zero tolerance to error is how I describe it, because you can't, if you make a mistake kind of in any piece of the value chain on a daily basis, the implications are you're going to alter the value, let's say, of a product that then gets sold out and it goes through transfer agency, it goes to wealth, etc. on the buy side. So it's got these huge implications. And so the industry has been built up with very thorough exception management processes to make sure that the data is sort of spot on every single time. And it's become an RPA process, I would describe it to this point. That's going to pivot with the help of machine learning and then generative AI into the next generation. So all of those processes start to become highly automated, and it just guarantees the integrity of data. It knows how to handle error handling, exception management, and it automates the end-to-end process.
I mean,
in a fraction of the time.
I get it, right? But you know, I've also done a lot of work in, you know, mass affluent wealth management advice delivery, you know, over the years as an experienced designer and as a strategist, and I can tell you probably 80% of the, you know, in terms of the mass affluent market, it's you know, product of the month rather than being a real advisory process where I'm drilling down into your needs and fitting a financial services product exactly to your needs, which is where this AI in terms of personalization is, I think, you know, got massive potential. And that means that if you are an advisor, if you're a IFA or a, you know, working for a likes of, you know, UBS, Credit Suisse, or, you know, these guys, you have to lift your game now, you know, because you are going to be competing against an algorithm that will be able to instantly personalize results for you. Yes. So I do think there's a threat there.
Think back to Reg BI, right? This puts an entirely different spin on interest.
All right, well, let's take a quick break. After the break, we're going to continue with diving into DeFi and ESG and the implications that climate change brings for the financial services space. We'll be right back after these messages from our sponsors. Welcome back to Breaking Banks. We are with Melissa Cullen and Tony Warren from FIS talking about the Global Innovation Report from FIS. And we're going to dive into DeFi. So when we talk about this decentralized finance market, obviously there's been some pretty big developments this year with the failure of FTX and Sam Bankman-Fried, or Bankrupt Fraud, as he's now known. But in terms of this, we've seen, as we were talking during the break, Tony, you were mentioning that there'd been a contraction from essentially this asset pool of $3 trillion of crypto and alternative assets in this space, including NFTs and so forth, and that's shrunk down to about a third of its size. Right now, keeping in mind that, you know, none of those asset classes really existed, you know, 12, 13 years ago either. You know, Bitcoin sort of being the first, if you like, back in 2008. But you know, there is an entire industry that has emerged around managing crypto, and it's not just the exchanges. We have a whole lot of DeFi companies working on, you know, alternative asset portfolio management and expertise there. You've got the metaverse now coming along, where you're going to presumably have a whole bunch of a need to quantify digital assets in that realm.
That's right.
But, and, you know, of course, blockchain. But, you know, just give us some of the highlights in terms of where these alternative DeFi systems are going now.
Yes, so I think you're absolutely right. I mean, look, the FTX collapse, and I'd actually combine that, Brett, with the condition that we're currently in and we've been in for the last 12 months. So kind of post-COVID, coming out of sort of extraordinary circumstance, then going straight into a war, which has then had an economic effect to mature markets. So you've got the FTX collapse, but in conjunction with rising interest rates, and then a flight at these sort of uncertain times, you then get a flight to certain assets anyway. So of course that's put additional pressure onto the market. Now, having said that, on our survey, 88% of institutional respondents and 75% of retail investors still believe that digital assets will see mainstream adoption within this decade. So it's kind of the train's left the station. It kind of got hit a little bit by the buffers, but I think the underlying technology is still there. So some of the challenges is obviously participation and then regulation in a highly regulated industry. But they are, you know, you can see some business cases starting to emerge. And I think over the next 5 years or so, we'll see, we'll pivot from a situation of this technology, particularly, you know, the blockchains and the whole decentralized finance, moving from looking for, you know, technology, looking for a problem to solve, to actually this becoming meaningful and helping to transform certain sectors of the industry. So I think there are some interesting cases already. If you look at the private equity market, it's been a very popular growing industry over the last decade or so, with a lot more participants in there. But it's still really only subject to a small pool of the investment community working in the illiquid and the private markets with the GP and the LP investment community. So there is a chance here that you could look at a tokenization of the private equity market. So you effectively start to bring in a form of unitization to that industry. And now the result of that could be twofold. One, for the LP, the current investment community, that would give them the ability to sort of buy, sell more fluidly. You know, you could find a buyer for your tokens if you wanted to come out of an arrangement before the GP moves the fund on, or it could really open up the doors to the adjacency. So if you think about how the world has shifted into DC pension funds, so everybody is looking at their own savings now for their own retirement, etc. So it's moved away from DB, it's moved away from government. More asset classes coming available, more long-term structures. You could be opening up to a whole new market for that private equity in the illiquid world. So that alone,
even the Silicon Valley Bank collapse really identified this problem that the banking industry has with, you know, simply trying to leverage deposits for, what do you have to do to provide return on deposits, even if it's at lower interest rates?
No, that's right. That's right.
And let's not forget, you have 50% of the world's commodities trade is energy. And we're undergoing the greatest revolution in energy management that humans have seen in the last 200 years. And so what happens to the commodities market around energy futures?
No, you're right. I think commodity is another area that could start, you might start to see decentralized finance playing a role. I mean, already, I know we're going to talk about ESG in a minute, but already carbon credits, that's a classic. It's a fairly new esoteric asset class. And it really is on that DeFi marketplace. And so ultimately, you might think about the asset management community using traded carbon credits to augment and raise the profile of their portfolio from an ESG standpoint. And I know we spoke about generative AI before as well, but I think, again, to your point on commodities, there's a role to play there, because I think as you combine all of this stuff and this data and next generational exchanges, I think generative AI is going to start to be used to look at that whole supply chain management. So from a corporate perspective, to actually see behind the scenes. So although at face value, I'm using XYZ materials for whatever I'm doing, the commodities that are driving that in the background could become very volatile, which is really going to impact, at the end of the day, the product that I produce from my corporation.
I absolutely agree with you on that. In fact, if you think about how we're going to value things in this sort of emerging world, and this sort of leads into the climate ESG discussion, we are already starting to see a shift away from corporations, just pure profitability as a measure, to now asking whether corporations are doing a good thing, and whether their activities are healthy for the community around them. And I think this is I think this is a philosophical paradigm shift that's going to
Absolutely.
occur. I think with climate change and AI, those two things coming together, AI is going to enable, massive, uh, you know, a massive sort of restructuring of the whole intermediaries play in terms of creation of value, and it'll be very, very difficult to compete with AI if you don't already have that in the capability. But at the same, so the traditional market function gets challenged. But on the same side of this, we're going to be saying, well, hang on a second. The 20th century produced all of these companies that were just profit at all costs.
That's right.
And what did it get us? It got us climate change. It got us 10 million
right.
people a year dying from air
That's right.
pollution, et
That's
cetera, right? So I think there's a really interesting opportunity here where when you're trying to create value in this new system, it is very alternative forms of behavior, and we're going to be emphasizing things that are beyond just purely, you make profit for the market. I think corporations are going to have to do good.
Yeah, it goes to perception, right? Perception of the value. We're seeing it already in kind of how corporations are measured. But what I am seeing more of now is also that trickling into who we do business with on a personal front, and how it will affect, right, our portfolios from a personal holding perspective. I cannot wait until we get to a point where risk tolerance, right, asks questions like, are you willing to trade off a 2% increase for a more balanced or, energy forward portfolio? So that's the kind of
you've seen HSBC and Barclays getting, having the naked protesters at the front of their offices because of, their fossil fuel positions. You saw Standard Chartered get into a lot of trouble for their greenwashing when they had this big ESG announcement, and then it came out that they'd invested 400 million in a coal plant in Australia, whatever. So how do we get real, moving into the whole ESG thing?
I think, this is such a wide subject, and actually we're doing loads of it. I think this is the inflection year for ESG in my own opinion. Melissa hit a very important point in that it's almost like starting to invest with a conscience, and now combine that with the demographic shift, which I was talking to earlier.
Very true.
That your wealth in your old age is no longer going to be the responsibility of the company you work for or the government in the country you live. It's going to be your own responsibility, and the DC fund, it's your pot, so you can make the investment decisions. And as people are becoming more and more aware, this does absolutely become an influencer. But the industry itself is still relatively opaque. And that, again, it goes to the lack of technology to this point, and really getting your arms around how to synthesize and control the data. So this is where I'd like to paint the future picture. Right now, if you have a savings product or your retirement scheme, typically the ESG balance is occurring on the wealth platform. So it's wholesale, where you're buying into a fund which has got an ESG badged credential. So its strategy in itself is a green fund or a sustainability fund. And then that's what's being used to then balance your traditional funds, which could be the S&P 500 tracking fund, et cetera, et cetera. So, you build your balanced portfolio strategy. I think the industry, because the incumbent, if you will, asset managers still need to protect their assets, and they may not be that bad. It's just that it's opaque. So the industry needs to give transparency into every portfolio, whether it's a UCIT or it's a 40 Act fund, etc. And the underlying companies need to be scored. So you've got to get consensus with firms like FactSet, Sustainalytics, etc., to come up with credible scoring, which then you can create an aggregate for any portfolio, which can say it could be attached to the NAV, and then that flows through the TA to the wealth platforms. And now you can actually make better informed decisions. So
Tony loves using acronyms.
NAV, net
So
asset
many
value.
acronyms, man.
Net asset value.
So
That's
are
why I'm
you
here,
talking?
so I can break
You
it
give the
down.
translator, the Tony translator. No, so I mean, are you talking about? I mean, I could see us having, from an investment perspective, particularly when we start talking about market performance. We're already talking about firms whether they're going to be carbon neutral.
Yes.
So imagine the stock market showing, here's your share price, here's your
Yes.
carbon neutral
That's
score,
right.
here is
Absolutely.
your community,
Absolutely. Absolutely.
wellness score.
Yeah.
So that the way we assess the performance of a corporation is no longer just going to be limited to their financial performance.
And
being able to
this
have,
has
go ahead, Tony.
no, so all I was going to say, this has massive ramifications because then you need regulation to ensure
Right.
people are being honest. So you don't get the greenwashing, you don't get the
Right.
other kind of pretending, if you will, of who you are. And that, Brett, is where generative AI is going to then kick in to apply it to the corporations themselves. So it can check, what are you doing? And then how can you increase? What practices do you need to be performing as a company to raise your ESG score? And the final point I'll make: climate risk is ESG is, and remember, I'll undo the acronym. It's environment, social, and government. So it's not just sustainability, but the climate piece also has a hugely sort of commercial point of view as well, because we know that there is climate change, and so climate risk to a company's assets and their immovable property is going to become a very important assessment for every corporation around the world as you're valuing the worth, the net worth of a company itself or a corporation.
I think not only that, right, the fact that we talk about ESG as a singular thing often and a singular score. And Brett, you hit on it. It's not going to be just about climate. Right. It's not going to be, and we have to start breaking that down. That's because different, whether it's investors or consumers, are going to want to weight different areas, right? So, hey, I want to make sure that I'm investing in companies or buying from companies with diverse management versus ones that are carbon neutral.
Right.
So I think that's where, right, the richer the data can get and the less basic of the scores, we're off to a great start, but there's so much more that needs to be done there. That's by exposing the data, confirming the data, right, that it's not just company driven to make those decisions.
I mean, right now, ESG within corporations, particularly in the financial services space, it seems to me it's more of a PR thing than it is actually a foundational thing. But is that changing, Tony?
Yeah, I don't know about that, Brett. I mean, by 2025, a third of the world's assets, so that's $53 trillion, are going to be in ESG rated companies. So it's really moving the needle, and that's my point.
So it is changing. Yeah,
it is changing, and I think regulation is going to swing in behind it as well to make sure, to your point, that it's not just lipstick. That this is very real. And so if you earn that score, you earn that badge, you are actually driving change throughout society.
A couple of years ago, you saw it plastered all over the mainstream media about the cost of Bitcoin mining in energy terms.
Yeah.
And yet, if we actually look at the financial services industry today, it's a considerably larger energy footprint than Bitcoin mining is. And so there's going to be pressure, as we build in generative AI, and we've got more compute power required, embedded finance, more compute power required, so we are going to have to sort of take a much different view to sort of the platform approach just on energy management, right?
Yeah, you're right. I mean, I think again, I mean, there's a whole other subject about cloud computing and the direction that will go. But just for argument's sake, obviously you've got private cloud, you've got public cloud right now, and of course the public cloud split between AWS and Microsoft Azure and Google. They are, to be fair, I think this is the top of their agenda as well. So if you think about consolidation of data processing on a worldwide basis, I know they are looking at strategies where, you know, they can create more and more cost-effective data centers, and they have their own sustainability and carbon neutral targets that they're working towards.
Fair enough. I mean, as a firm that obviously supports a major portion of the US, infrastructure for financial services from a computing perspective, how is this changing the design of core systems, the view of on-prem versus cloud, and so forth? To get more efficient, environmentally friendly computing platforms.
Yeah, I'd say we're wearing the same badge, Brett. So we have carbon neutral targets. We take it very seriously around sustainability, and we do have an ESG score, which we work hard at to achieve across all of the three sections. But from a product design point of view, you're right. So we look at how we can be the most productive. So, where it makes sense to be multi-tenant, so you're using less CPU, you're using less churn to support the outcomes that we need. But sorry, Melissa, you go as well.
No, that's exactly where I was going, right? That it's finally become part of the design process up front. Yeah. It's not just deploy and now it's, whoever's hosting the software's job to figure out how to maximize it. So it's a big part of all of our next gen design sessions, whether that's for the retirement cores, banking cores. So I'm highly encouraged and looking forward to start reporting and measuring it.
Yeah. Now, Tony, you talked about robotic process automation. We've talked about supply chain automation. Obviously, a lot of the systems we use today in terms of value exchange are going to see a high level of automation over the next 20 years. We're going to be tokenizing that. We have smart contracts we're going to need to implement that. So you could see, if we extend this out and extrapolate in 20 or 30 years, a very big part of sort of the global market in terms of trade could be machine-to-machine interactions rather than being handled by markets as we do today, markets as an AI function. So how does that change the way we value markets in the ecosystem? If markets are just algorithms, then
it's a good point. I mean, I suppose I don't have a crystal ball on it. I think you can make some pretty firm analysis. If you go back, I mean, there was this thing, right, called Big Bang. Do you remember this? Big Bang. It was back in 1987. Before then, the stock exchange was open outcry. It was pieces of paper. You were running down to a bank. You had to fill out a transfer document. You stamped it. So how many, that's 36 years ago. So maybe it's a little more, but the way technology, I would say, has picked up its pace in the last decade, even, think about that transformation that's occurred over the last couple of decades with the financial services ecosystem. So another 20 years, I think your assumption is probably quite solid, Brett, that it becomes.
Well, I'm a futurist, Tony.
Yeah, exactly.
I mean, you're already seeing it in other industries, right? Brett, you mentioned the legal industry, and now you have these generative AI, bots negotiating against one another. So it is certainly not far off in financial services.
Yeah. So, in terms of the ESG stuff, we've talked about customers self-selecting, players, corporations that they want to work with based on their core set of values. But what other impacts do you think that ESG overall is going to have on the consumer market?
We talked about it affecting where they're going to invest. I think it's also about where they're going to buy, and what they're willing to spend and how they associate value. Right. So today it's simply about the use of whatever you're buying, you attribute a value to. I do think that score is going to become more prominent and change the way we value basic goods and services, for that matter. Tony, what do you think?
No, I completely agree, and I think as a, let's call it almost like a value added, I actually think it will become part of the trading algorithm. So when you look at portfolio management today and you're choosing where you want to invest, I think it's going to look at, okay, this one firm, they either haven't taken it seriously or they just don't, they're not doing anything about it. I think the algorithms will recommend a peer company that is in a much stronger position
and a
similar
product,
performance, similar product. Absolutely, absolutely.
So and this goes back to recommendations, right, Tony, that you hit on in the beginning.
Absolutely,
I mean, it is a recommendation.
Yeah, and so that could be a driver of success at the corporation level, because it's going to attract new investments.
Yeah, it's such a philosophical change, isn't it?
Yeah.
Like, we've been so used to gearing our investment decisions and so forth just purely based on return.
That's right.
Alpha, Sharps, beta,
exactly.
all these ratios, etc. CAGR. It's all about economic return. And now you're talking about introducing a whole range of other measures that's going to come into whether you're an attractive company to invest. I mean, assuming that AI produces incredible wealth from its investment, generating returns is not necessarily going to be as differentiated as it is today, because it's going to be algorithm based.
But I think what we'll find though, Brett, is that over time you'll start to see a correlation between good ESG practice and financial performance anyway,
right?
Because you're going to have a better workforce, inclusive, diverse workforce. So you'll have longevity, better talent pool, and then ultimately, if you're looking at sustainability, you're controlling your energy costs, so therefore your exposure to fossil fuel energy, as we've obviously seen in the last couple of years. So there's all these other things that can actually, I think, long term will translate into economic outcomes anyway. So,
Tony, are you seeing this posture change at the board level? Board members and executives of the largest FIs, are they getting really serious about this stuff?
I think so. I mean, I don't have any special
insight,
but I think overall there's definitely a sense. I mean, I can tell you our firm, absolutely, we have diversity, inclusivity targets, and as I said, we've got carbon neutral targets. We take it extremely seriously, and I think most modern large corporations do. Would be my.
It's funny. I mean, I just tweeted out the other day because SpaceX, when they had Crew 5 return from the space station, a couple of weeks ago, they had an all-female crew handling the return of the SpaceX Dragon module, and I made a comment about how it really was quite positive, and then I got piled on by all of these misogynistic
it's not good. There's still
about it's not very diverse having an all-woman crew and all that sort of stuff, and I'm like, come on, haven't we got past this? But there's still work to be done.
Missing the point, right?
Yeah,
correct. And I will say on that one, it's I look forward to the day when we don't have to call it out, because it's
that's right.
More of the norm. But I see it from.
It has to be a cultural shift. You're right. So where can we find out? Where can we get a copy of this report? It sounds really interesting, and the research that you guys have drawn on today.
We'll send that to your organization, Brett, so we can attach it.
Well, we'll tweet it out. I do have the URL here. It's www.fisglobal.com/global-innovation-report. It's pretty easy, actually.
That's a great plug, Jack. Thank you.
Right on the website. So it's one of the featured things, and there's a lot of great data that we didn't have time to touch on. So definitely check it out.
All right. So here's an interesting question for you. We didn't talk about it beforehand, but looking out 10, 15 years, how do you think this is going to change the makeup of the leading financial services organizations globally? Is an AI company going to be the leading financial services player? Is it going to be a more socially oriented play? Where do you think that's going to lie?
I personally think it's going to be all about marketplace procurement, digital marketplace procurement, to be more specific. So is it going to be the, Amazons or Google's getting into banking in a bigger way? Who knows? But they'll certainly be bringing those services to market, and not just consumer services. I think it'll extend to B2B and to cap markets.
I think that's right.
Yeah, in Bank 4, which was published December 2018, I predicted Ant Group, right? But that was before Jack Ma got the bullet from the CCP. So anyway, but how do we follow you guys individually? How could where can people find out more about you or follow your musings on the topic?
I am off Twitter these days, but LinkedIn is where I'm doing most of that.
Yeah, okay. Likewise, I post onto LinkedIn with all of the latest and greatest.
Fantastic. Well, we'll include links to your profiles as well as part of the show. But Tony Warren, Melissa Cullen, thank you for joining us on Breaking Banks.
Thank you, Brett.
Thank you.
Great stuff. Cheers.
That's it, guys, for Breaking Banks this week. Some really interesting topics, AI, ESG, all very foundational and informative stuff for what comes next. If you like the show today, please tweet it out. If you're still on Twitter, if you're on LinkedIn, post about it, tell your friends. All of that helps us get some traction. And feel free to leave us a review. That's also important. Because it helps people find the content. And if there's guests you'd like to see on the show, let us know as well. Our thanks go out to the team that produces Breaking Banks every week, Kevin Hershen, Lisbeth Severance, and the social media team, including Carlo and Sylvie, and of course my co-hosts, JP and Jason. We'll be back with another Breaking Banks next week. Until then, stay well. That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.